As we've mentioned in many marketing interviews, the EPA will decide in November on a waiver to the ethanol requirement of the renewable fuel standards. One side argues using corn for ethanol drives the cost too high for feed, but some analysts believe a waiver wouldn't do much to ease price. Either way, there's a market for ethanol and there's a market for dry distillers grains made in the process. But as we look 5 to 10 years ahead, how will the demand for those two products affect corn price? We talked with Dennis Conley this week about how different ethanol blends and DDG export markets could drive corn in the future.
If we actually look at the 10% blend, what they bumped into was what was called the blend wall, which would be about 14 billion gallons a year. The renewable fuel standard is 15 billion gallons. So they raised the blend wall and said you could have a blend of 15% ethanol in your gas supply. That raised it up to 21 billion gallons.
But there is a wall that you can hit, and that means that there's also a number of gallons that you can hit.
That's right.
So what's the difference there between production from the low end to the high end?
The difference between production would be probably in the 14.5 billion gallons to the high end would be 21 billion gallons. Now, there's a lot of things that have to be in place in order to get to 21 billion. So we think it could come out somewhere between, say, the 15 billion and the 21 billion gallons.
This summer we read a lot about ethanol plants in Nebraska getting hit hard because they weren't making enough money. Some had to close down for at least a short period of time. When you look at the margins, what are the margins for the ethanol plants in this state?
In Nebraska, and we'll use Nebraska as a proxy for all the major producing states, you go back 5 or 6 years and they had great margins. But in the last year or two, those margins have become less and less. And as we look for this year at the margin for ethanol, it's actually negative.
And what's impacting that? Because you're getting DDGs and you're getting ethanol. Is there anything that can bring it back up or anything that's saving it from being worse?
Yeah, you said the key words there. It's now two products, ethanol and DDGs. And the DDGs still have value as co-product. So when you combine the two margins, you're actually still getting a positive gross margin and a positive net margin.
The DDGs are therefore buoying it a bit?
The DDGs are keeping them alive.
We talked in China in June about a distiller's grain market there, and they've become a major importer. We've seen a sharp peak there from importing from the United States. We've also seen exporting from the U.S. to Canada, to Mexico. Why have these countries been able to capitalize on getting DDGs from the United States?
Yes, I know Market Journal is in China this summer and looking at the grain and the oilseed industry there. Very, very interesting. And what has happened in China's case is that they ship a lot of materials to the U.S. in these containers, clothes, shoes, electronics. And when they haul those containers back, they don't have anything in them. And they've discovered that they can put dried distillers grains in those containers and ship them back to China very cheaply as a backhaul. And then the feed industry in China is now learning how to use that to feed their livestock and increase their protein production.
As with any import or export from the U.S., the strength of the dollar makes a difference. The strength of the dollar right now isn't that strong. On the other side, China is seeing an appreciated currency. What happens if that continues? Not only China, but Canada, Mexico, if that currency continues to appreciate and the dollar doesn't, how does that affect the import market?
When you have a weaker dollar and stronger foreign currencies, China, Mexico, Canada, South Korea, other countries, which we have had for the last 10 years, our exchange rate, corn traded exchange rate, has been declining for the last 10 years. That means that those countries buying distillers grains, buying corn, buying anything, it's cheaper for them. They can get more for the same amount of money. And so that's a pivotal point here as to what does that exchange rate look like going into the longer term future.
And they capitalize, obviously.
They capitalize on that, yes.
Play out a few scenarios for me. One is if the U.S. doesn't meet that requirement, the RFS requirement, and that's what the USDA is projecting now, correct?
Mm-hmm. Yes. If we take the long-term projections of USDA, their figures for supply and disappearance of corn, their numbers are showing about a 14.5 billion gallons of ethanol production out to 2015, 2017. We take that scenario and we would come up with a set of prices over the next 5 years that would be pretty much in the new normal that we've seen in the last couple of years, the $4 to $6. They'd run from probably about $3.90 to $4.50 a bushel for corn.
If the U.S. does meet that requirement on the other side to 15 billion gallons, what does that do to the price of corn?
Just raising it a little bit, a 500 million gallons, then the price for corn on the projections would go up, probably about another 50 cents to $1. So now we're talking about $4.50 to $5 range for corn. Not right away, but when we're looking at maybe 3, 4, 5 years.
Is that the most likely scenario?
That is the most likely scenario. You know, if I had to put a percentage on it, I'd say that's probably a 60% probability of that scenario.
If they blow through that on the other side and they surpass the RFS, what does that do to the price of corn?
If they blow through it, or really not even just blowing through it, but let's say they go to 15 billion gallons and this export market develops,
Sure,
as we are projecting under declining exchange rate, increasing feed demand in developing countries, the ethanol goes to say 16.5 billion gallons, just a 10% increase over the standard. Then we're looking at what I would suggest is a second new normal. We're talking about prices that will be in the range, price of corn that will be in the range of $6 to $8 a bushel, looking out about 3 to 5 years, 2015, 16, and 17.
And the chances of that happening?
I think the chances of that happening are less than 50%, maybe 30%, maybe 40% at the outside. But when farmers, ranchers, agribusinesses, those in agriculture, commercial agriculture, agribusiness, have to think about the future, I think this is a scenario that they have to consider.